Hi all, and welcome back to Money Managers, a User's Guide. I'm Nathan Peters. After a couple of weeks off for the Easter holidays, of course, a lot went down in the market while I was away, so forgive me if some of this is old hat, but I'll bring it back right up to the present, I promise. So, Jay Powell started the big, chunky 50 basis point hikes, and the market is just relieved it's not getting a 75 basis points poleaxe, at least for now. This is a data-dependent Fed, remember, and the market's already done a lot of the work for Jay, as bonds, duration, interest rates have posted their worst start to a year ever, i.e. since the current benchmark such as the Bloomberg aggregate began. 2 Sigma puts the total for a residualized interest rate factor at negative 7.3 through Tuesday, and over 1 year at that factor has the lowest Sharpe ratio at negative 2.1 Sharpe. As Jim Bianco notes, it is the worst start to the year for bonds since 1980, so it's bad out there, really bad. So who's been getting it in the neck then? We haven't seen large levered funds a la LTCM imploding yet, but scanning the hedge fund league tables, the following 2 large funds are getting into their largest ever drawdowns with not a lot of evidence of a recalibration to the reality of a newly hyper-hawkish Fed. Now these are fully active, absolute return, multi-asset funds, so macro funds, if you will, and they raised much of their assets after correctly levering up long bond portfolios during the long bull market, especially through the GFC. Both funds have benefited from negative historical correlations between bonds and stocks, which dampen volatility without harming returns while enabling daily dealing with good liquidity. But as investors in the 1990s observed, stocks and bonds can be positively correlated as well. They just haven't both fallen a lot at the same time since the 1970s. Cue large unexpected losses as the ballast starts to pierce the hull. So Legg Mason Western Asset Macro Bond Fund has an AUM of $3.2 billion, and its year-to-date losses through Tuesday are negative 22%. That's about $670 million. Carmignac Patrimony AUM is about $10 billion, and year-to-date losses are negative 8.4%, so about $850 million. That looks a lot worse than the Bill Ackman Netflix loss, doesn't it? But I guarantee you won't hear as much about it. So let's give these funds a little more scrutiny. It appears the Western Asset Bond Fund became too enamored of less liquid spread product and EM risk at the same time that it sold down its large treasury holdings, as an example of asset allocation decisions becoming internally inconsistent due to liquidity constraints affecting one part of the portfolio more than the other. For investors along for a ride, this is shocking, unless you are closely watching the manager's capital discipline and total portfolio liquidity. It's not something most individual investors have the time or inclination or skill set to do. Meanwhile, as of the March fact sheet, the fund retains a high 7.6 years of duration. I wonder what the liquidity profile of the fund looks like now. Investors aren't really waiting around to find out, and the fund has lost about $2 billion in AUM last quarter, according to Kepler Absolute Hedge. So looking at Carmignac Patrimony, it actually didn't have much beta to bonds going into this year, and their active risk-taking just started losing money at the same time, which included Russian securities and tech stocks. Looking at their monthly commentary, it appears they did try to buy the dip in bonds in Q1, adding 4 years duration in February, but then selling out of it again as they lost over 1% at the portfolio level in March due to bonds. Investors here are also voting with their feet, redeeming almost $2 billion here in Q1 as well. Now, Ken Leach at Western Asset and Edouard Carmignac are legendary investors, and I'm not by any means casting shade on their many achievements. The funds got big for good reason. It's just that investors who want strong forward-looking returns need to scrutinize more than just a manager's record of success to make sound decisions when allocating. An awareness of the macro environment, fund management incentive structures, decision-making models, and portfolio liquidity all play important roles in getting to the right answer for your portfolio. Just like Cathie Wood at ARK, Western and Carmignac make more money when they manage more money, not when they make money on your money. Investment losses accrue to their clients, and the managers do just fine. Active management needs oversight. And unfortunately, the industry too often glosses over a sober, probabilistic assessment of the uncertain future with past certainties and glories. inevitably bringing ever greater dollar amounts to the wood chipper of the markets in the process. Sorry for the dour ending, but these are dour times. Best to own up to it and prepare. That's it for me today on Money Managers, a User's Guide. If you found this content helpful, please like, comment, subscribe, and hit the bell for notifications of future episodes. And remember, use your money managers. Don't let them use you. Thanks.